Good morning, hello and welcome to Money Control's live stream. You're watching Opening Bell with me, Lovisha Darad. Well, it's a brand new day, and after yesterday's sixth day of sell-off, the GIFT Nifty is hinting at another negative start for the Indian markets as FI sell-off extends to the sixth straight day as well. But we'll be watching out how the day develops as well. The pre-open rates are also hinting at a flat to negative start for the Indian markets. We have had a negative global handover as well. Wall Street ended on negatively overnight as Treasury bond yields rose the highest level since August. Asia Pacific markets, that is interesting because Chinese markets, they sharply rose by 11% after a week-long holiday. Rest, Japan, South Korea, Australia, they were all largely tepid in trade as well. But we'll be watching out on how the market texture unfolds during the day. Plenty lined up in the show. Don't forget, we will be taking up your stock-related queries with our technical expert and understand how they look on the charts as well. So keep posting your queries in our live feed and we will try to address them before 9:30 a.m. For now, let's take a look at the top headlines this hour. Closes lower as 10-year bond yields retreat to its highest level since early August. Dow Jones dropped nearly 400 points lower while Nasdaq Composite and S&P 500 indices ended 1% lower each. Majority of Asia Pacific markets opened lower this morning. However, Chinese markets stood as outlier, beginning its day sharply higher after a week-long holiday. Back home, GIFT Nifty is indicating at another negative start for the Indian markets. Brent crude prices fizzled rally after hitting $81 per barrel, its highest level since August. Escalating tensions in the Middle East have popped up the oil prices. Meanwhile, gold prices see a setback after US dollar hovered at its highest level in 7 weeks. Assembly election results in Haryana and Jammu and Kashmir will be out today. The counting of votes have already begun and exit polls indicated a change of power in Haryana and tough battle in Jammu and Kashmir. Chinese markets, that is the headline for today. We are seeing CSI 300 index, which has popped up 11% in early session after a week-long holiday. Back-to-back brokerages have been coming in saying that they're increasing their weightage towards China. And all this is coming at the expense of reducing weightage in India as well. Even yesterday, CLSA pointed out in its note that they are reducing the overweight stance on India to 10% from 20% and increasing the weightage on China to 5%. This comes after India's outperformance by 200% against China, and they have flagged off overstretched valuations as well. Even Jefferies, for that matter, even they reduced India's weightage in its EM portfolio and increased exposure to China as well. So be it US-based Chinese ETFs, cumulative inflows to Chinese markets, or hedge funds shifting their positions, all of them are indicating how fund houses are going big on the buy China call. But we'll see, how deepening impact that'll have on the Indian markets, and we'll be understanding with our experts as well on the show. But if we take a quick recap of yesterday's trading session, Sensex and Nifty, they extended their losses to the sixth straight day. All the sectors nosedived in red, barring the Nifty IT index. Broader indices, they also extended their losses to the third straight day. We have the RBI MPC outcome, which is coming in tomorrow, and the Q2 results, which will be beginning later in the week. So we'll see how the market navigates through these activities as well. Coming to the option Qs data, Nifty put call ratio, that dropped to 0.67 levels from 0.69 levels, showing there is some sign of unease in the markets as well. In the F&O ban list, IDFC First Bank, Punjab National Bank, there were all the new entrants in the list, whereas Bandhan Bank, Birlasoft, GNFC, Granules India, Hindustan Copper, Manappuram Finance, RBL Bank, they continued to be part of the F&O ban. None of the stocks were out of the F&O ban list as well. If you look at the foreign fund flows data, FIIs, they have continued to be the net sellers for the sixth day, selling to the tune of 8,300 crore rupees in the past session. So far this month, they have already sold nearly 50,000 crore rupees in the cash markets as well. DIIs, they however continue to hold the fort. They bought around 13,200 crore rupees in the cash markets. So the DII buying, however, they kind of compensated than the bigger sell-off that was given by the FIIs. So just a couple of minutes for the opening bell before we hit the opening bell as well. The pre-opened rates are indicating a negative start for the Indian markets as well. But on that note, let's quickly get on board with our technical expert of the show, Ajit Mishra of Religare Broking. Ajit, good morning. So good to have you on the show.
Yeah, good morning, Lovisha. Same here.
Ajit, as I was talking about, FIIs, they have been net sellers so far this month as well. So how much of a downside can Nifty see from here on? Yesterday also it broke below the 24,750 support levels in the intraday deals as well. What are the new levels that we're eyeing for now?
Right. So, Lovisha, if you see the market performance, in the recent month, in fact, for the entire year, if you see that we were most of the time we were seeing more of time-wise correction in the market, but this time around we are seeing some serious price-wise correction. Means still, why would I say serious? Because earlier we were not, in fact, witnessing this kind of a dip, which is 5.5% kind of a decline that we have seen in the index so far from the record highs. And earlier it was very tight range consolidation that we used to see. And another important aspect that earlier we used to see that mid cap and small cap, they were the one which were used to face the heat more, but this time around is the other way around, that index heavyweights, they are facing the heat, of course, and that is reflecting in the FI selling data which you have just shared, that 50,000 crores they have already sold in this month so far. So keeping this scenario in mind, plus technically we have seen multiple changes in the structure from the short-term point of view, that we have slipped below the short-term averages, which was placed around 25,550. Then we had a trendline support around 25,350, which we decisively breached in the same day. And now, despite the oversold position, we are not seeing any sign of decisive recovery. Yesterday, the previous swing low closed around 24,750. We have penetrated intraday, but on the closing basis, we somehow could manage to end marginally above the same. So my observation is that we are likely to see further pain in the market until we decisively reclaim 25,550. So one should maintain, sideways to negative bias. If we talk about intraday, positionally, it's a negative bias clearly. The next major support comes around 100 EMA, which is placed around 24,350. So as of now, most of the sectors or heavyweights, they are also pointing towards the same. One silver lining that we have is that we are still not seeing any major correction in the global market. But still, since we are not taking any clues from that as of now, and the heavyweights, yes, they are very closer to their major support. So be it Reliance, HDFC, ICICI, which were down and out. So last week itself, Reliance was down nearly 9%. So close to around 2600, 2650 zone, we have multiple supports for Reliance. And similarly, for HDFC and ICICI, we are very closer to the major support zone. So that might result in some consolidation in the market. But for any meaningful recovery or reversal, we need to see, whether Nifty manages to cross 25,500 decisively or not.
Okay, 25,500 decisive breakout. They'll be watching out for Nifty 50. But Ajit, Bank Nifty, that slipped below 50,200 levels in yesterday's trade as well. So can we expect it to breach below the 50,000 levels? Because, as you rightly pointed out, that we are seeing, the reversal trend is a bit difficult from here on.
True. In fact, if we see it on a longer time duration, the performance of banking index, we are very closer to the critical juncture wherein we are set to break down from the declining trend line of a rising channel. So that might result in more pain, and like what we are, seeing that FIs are, on the selling spree. So maybe close to around 49, 300, 400, the next major support, which is the 200 days of exponential moving average, which indicates a long-term trend. That might be the area where banking index might take a breather. So around that area, obviously, one can see that, HDFC and ICICI, they might also reach closer to their monthly support zone area. So that might result in some consolidation. But before that, yes, there's a possibility that this pressure may extend.
Okay, some pressure that we will be seeing maybe in Bank Nifty index as well. But 49,300 levels that we will be watching out for Bank Nifty index as well. Just a couple of minutes, just a couple of seconds before we hit opening bell. And yes, the first rates right popping on your screen as well. Nifty flat in trade up about 0.1%. It is above that 24,800 levels for Nifty 50 index as well. Sensex, however, Sensex is also showing signs of recovery. It is up about 0.2% above the 81,200 levels as well. What we are seeing among the sectoral indices seem to be doing well is your Nifty Bank Index. Bank Index is about 0.5% up. Otherwise, most of them, trying to participate positively in the trade. Nifty Auto Index, that is down 0.2%. Nifty Metal Index, once again extending the losses to the fourth straight day as well. It is down about 1% in trade as well. PSU Bank, that is holding up well. It is up about 0.3% in trade as well. India Wix is still above that 15 levels. It has cooled off a little bit from yesterday. It is down about 0.4%, but still above that 15 levels as well. Broader markets, if we look at it, we can see the sell-off continuing to the fourth straight day as well. Both mid-cap and small-cap indices down about 0.4% each as well. What seems to be doing well on the Nifty 50 charts is HDFC Bank. It is up, a percent in trade. Apart from that, we can see HUL, M&M, Cipla, Shriram Finance, Trent, all of them holding well in the Nifty 50 top 50 list as well. What seems not to be doing well on the Nifty 50 charts is the likes of Tata Steel, Hindalco, JSW Steel as well. So most of the metal names, they are seeing a bit of a profit booking in today's trading session, and they are dominating some of the Nifty 50 laggards list as well. The other list that comprises of is Tata Motors and Power Grid as well. They are also down up to 2% in trade as well. But since we talked about Bank Nifty as well, HDFC Bank, it is one of the index heavyweights, and yesterday it also remained one of the major contributors to Nifty fall. Today is, however, it is holding up well on the charts. Yesterday the news came out saying that the private lender is divesting its complete stake in HDFC Education to Vama Sundari Investments for 192 crore rupees. Vama Sundari Investments, that is a related party of HDFC Asset Management Company. Hence, the sale of shares to Vama Sundari would be a related party transaction for the bank. But Ajit, on the charts, how does HDFC Bank stack up, since it has been one of the major contributors for Nifty 50, up move or even the down move as well?
True, Lovisha. In fact, when we reached closer to 1800 mark, that was the area basically where SDFC has the last, 52-week high or record high, but it couldn't surpass that. And since then, we have been seeing a gradual drift. That it has completely incurred the entire gains that the stock had witnessed in the recent months. So now again we are closer to the support zone. So close to around, let's say, 1590, 1600 zone is something that we have multiple support area. So again, there is a possibility that we might see some consolidation around that zone before making any meaningful up move. So short term, it might continue to hover in a range, is something that what the indications are, and that is what Bank Nifty is also indicating. So it's largely that be it ICICI, SDFC or Axis, they are likely to remain in the range. But the good part is that we are very closer to the major support areas.
Okay, so major support areas that we are nearing for HDFC Bank. Ajit, Nifty IT index, that did well yesterday in yesterday's trading session. So can we expect some further upside given Q2 results are also around the corner as well?
So Lovisha, this is something which is very important and critical, because three sectors which were holding strong till Friday was IT, pharma and metals. Since yesterday, we have started seeing some profit taking and decline in metals counters, but IT is still holding strong, and pharma is selectively we are seeing participation. So it's important that if Nifty has to see any meaningful recovery and sustain the level of 24,750, then IT should outperform. And as of now, indications are in the favor that yes, the IT majors, especially Infosys, TCS, HCL Tech, they are almost done with the consolidation, and they are still holding around the record highs, especially HCL Tech and Infosys. So this probably may result in possible breakout post numbers. So it's definitely a good sign if before the earnings and when the markets are falling like 9 pence, if any sector or stocks outperform, that shows that there's anticipation that there'll be a positive surprise in the earning. As of now, yes, one should stay put in the IT majors. Mid-cap IT is something that are still vulnerable for volatile swings or decline. So for a time being now, it's prudent that one should stick with the IT majors, the top three names, and avoid the rest of the pack.
All right, avoid rest of the pack. But we will be watching out on how the IT stocks performing in the coming days, given that TCS will be starting off the earnings season on October 10. Most of the brokerages are also expecting Infosys to review its earnings revenue guidance for the upcoming fiscal year as well. But coming to the next stock in focus, Nykaa. In its September quarter update, Nykaa said that they see mid-teens growth in consolidated net revenue, while net sales value has grown in early teens as well. Nykaa said that they are witnessing a strong performance in its retail omni-channel business despite subdued fashion demand in the first half of the fiscal year. Ajit, Nykaa on the charts, the stock has been coming off its 52-week high that it hit in August as well. So can we expect some bullish momentum to continue from here on?
So yes, in fact, post the consolidation range breakout from 145 to 180 range, the stock moved up very sharply to 220. But eventually, we are again seeing that the entire gain is engulfed in the recent weeks, and now we are again closer to the support area. Good part is that we are not seeing any volumes. This indicates that sellers are exhausted now, and we are closer to the major support zone, which is placed around 180. So yes, there's a possibility that we might see a reversal or a rebound, a sharp rebound rather. So with stop at 180, one can continue to stay put. If you have any existing position, and you can in fact look for fresh longs also with 205 to 10 as a position target.
Okay. So we will be watching out on Nykaa's stock performance as well. Another stock in focus is Bharat Electronics. The company said that it has won total orders worth about 500 crore rupees since September 11, and the company has guided for another 25,000 crore rupees worth of order inflows in this fiscal year as well. Ajit, Bharat Electronics on the charts, it is off 8% in the past 5 trading session. We have seen that it has made a debut on the Nifty 50 pack as well. So should investors buy this dip?
So in fact, Lovisha, that the entire PSU pack, be it the railways, defense, PSU banks, they were all witnessing gradual decline, and still there is no sign of reversal yet. Yes, intermediate rebound and recovery may happen due to the oversold position. So for BEL also, I'm seeing that the stock might continue to, though it's comparatively, performing better if we compare with the other PSU's name, because it has retraced or roughly around 30-40% from the record highs, but others are down already like 50-60%. So comparatively, we are seeing better performance, but since we still have more legs to the current down move, until we close and sustain above 280 mark, one should refrain from any trading position in BEL for the long side. And positionally, the stock might inch toward 250 area in days or weeks to come. So if you have any existing position, you should maintain a stop at 260 and use any recovery towards 280-85 zone to reduce your trades.
Right, 260 level and 280 levels. We will be watching out for BEL. Let's straight dive into the viewer queries as well. The first query coming in from Satya, he's asking, please ask the charts for CAMS for making a fresh entry for say about 1 to 2 years. CAMS, Ajit, it hit a 52-week high in the month of July, but ever since that, the stock hasn't really performed well as well on the charts. Can we see a breakout in the next upcoming sessions for CAMS?
In fact, it's comparatively better to what we were seeing in the other, stocks in the mid cap and small cap space. The stock was hovering in a very tight range around the record highs. But yes, of late, there's an indication that this consolidation may extend because the breakout attempt failed, and now we are seeing profit taking. But still, the way volumes have dried up, that indicates again like weak hands basically leaving the stock. So yes, you can continue to stay put. If you are planning for any momentum trade in the stock, then you should wait for a breakout above 4600 mark. Otherwise, it might hover in this band of 4000 to 4600 at least in the near future. But if you're okay holding this stock, let's say for 3 to 6 months, then you can start accumulating in the current levels with 3800 being the stop loss. And once we break 4600, then there'll be a fresh momentum towards 54,600. So yes, the stock looks positive overall. You can continue to accumulate on dips.
Okay, so accumulate on dips, that is the call coming in. Another query coming in from Shrikant Chavan. He's asking advice on Bharat Dynamics. He has bought the stock at the levels of 912 rupees. He's asking if he should hold the stock or sell and book profits. Currently, Bharat Dynamics, it is trading about 1000 levels, odd levels, Ajit. But in the past 1 month, the defense flavor has been, fizzled out. What can we expect in the near term?
Exactly, Lovisha. So, in fact, this gentleman had bought it at very lower levels, and then he saw a high around 1800 mark, and then now he's okay selling it marginal gains. That is what we always try to explain to our clients also, that when we see any extraordinary move in any extraordinary sector or themes, there's no harm booking at least partial profit, after a certain threshold, let's say 20%, 30% kind of a gains. Now, since most of the defense related counter they seems exhausted, means the selling have uh, seems like there's negligible selling at current levels. So we may see some consolidation and followed by a rebound. Since you have bought it at lower levels, I would rather recommend you to maintain this position now for the possible target of around 1200, 1250 with stop loss at 1070 on the closing basis.
Okay, so hold position and a target of 1200 odd levels coming in for the stock. But another stock that is query coming in is from Patrick. He's asking the view on Indian hotels. Indian hotels, Ajit, so far this year the stock has been given a very decent return. It has underperformed benchmarks as well. Can we expect a further upside from the current levels for Indian hotels?
So yes, it has performed exceptionally well, and this time around also, what the correction that we are seeing, the momentum is missing. So it's a good part, and we are closer to the support zone also. So close to around the 640, 630 area, we have multiple support plays. So if you are okay with slightly deeper stop losses, 630, then you can continue to stay put. Once we break 675, that there will be a fresh leg of up move in the stock. So yes, you can maintain your longs with 630 being the stop, and for the positional target of 720 again.
Okay, 720 coming in for Indian hotels as well as a target. Raj is asking his advice on NBCC. NBCC stock on the charts, Ajit, so far this year it has given a stellar performance, but from the past month it is seeing a bit of a consolidation. Can we expect a further upside and ignore the consolidation that is coming in for the stock?
So yes, as of now, we have not seen any major damage to the price structure, but post bonus, yes, we are seeing some sort of profit taking intensifying. So from the trading point of view, I would be like very strict with my stop losses, because we are still closer to the record highs and we have room on the downside in case if it corrects. So with stop loss at 108, I suggest maintaining the long position. Once we break that, then there's a possibility that the stock might retrace to 95 or 98 area. Upside, once we have a closing above 125, then there will be a fresh leg of the up move, which can help this stock to inch toward 140 plus soon. So as of now, it's a hold with 108 as a stop loss.
Okay, so hold coming in for NACC. Another stock in focus is Sobha. Sobha has come out with its September quarter update. It is seeing a sequential drop in its total sales figures as well. Today, the stock is also down about 2% in trade as well. Ajit, on the charts, Sobha, it did see a breakout from the September 11 onwards, but the past week it has been languishing in trade as well. So, what is the next levels that the stock can eye?
Right. So, in fact, in the entire realty space, if you see, Lovisha, that we are seeing profit taking, but again, in line with what we are seeing in the other sectors, we are very closer to the critical support in realty space as well. And for Shobha also, that the last consolidation range bottom is placed around 1600, 1620 zone. So we are very closer to that mark. So if you have any trading position, you can stay put with the 1600 being the stop. And in case of recovery, 1800, 1850 is going to be the area of resistance. So if the view is short term, then you can use that recovery to reduce your position. Likely, in all scenario, we may see the stock witnessing further profit taking if it fails to hold 1600. Then it could be a serious trouble for the stock, because it moved almost vertically from 400 to 2100 mark. So we have not seen any meaningful correction yet. So below 1600, definitely you should exit.
All right. That is the view coming in for Shobha. One more query that is coming in from Hari Krishna Lenka. He is asking if Suzlon correction is the right time to buy the stock. Suzlon, Ajit, it has fell for eighth straight day. Today also the stock is down 1% in trade. There have been some concerns by the advisory, concerns by the BSE, and some corporate governance practices as well. But Suzlon, on the charts, do you expect a certain momentum to pick up in the near term?
So yes, today, after retesting the 100 EMA, we are seeing some respite. Means we are seeing recovery, though it's still down. So there's a possibly, the stock might inch towards 74, 75 area, but the tone looks sideways to negative to us. As of now, I would say that if you are planning any fresh trade, let it stabilize above 65, 66 decisively for a day or two. Then you can look for long position, not at the current levels.
All right, just one final query. Shatabdi Ghosh is asking her view on PC Jewelers. PC Jewelers, it is down in today's trading session as well. In the past 1 month, however, it has outperformed and it has given about 10% returns. Ajit, on the charts, what is the next level that we can eye for PC Jewelers?
Right. So, Lovisha, we always recommend that if you are chasing any stock which trades largely in circuit breakers, then you should be very strict with your stop losses. The stock moved up from 45 to 188 in just no time, and now we are seeing a decline also in circuit breakers. The next support comes around 130. So that should be your strict stop loss, and in case if it sees any bounce toward 155, 56 area also, then also you should liquidate.
All right. So, just one final question for you, Ajit. What are your trading picks at this hour? Because we are seeing quite a bit of a sell-off in the recent sessions. So, what can be a good buy at this point of time?
Yeah, so like Lovisha, we've discussed about IT is still holding strong. So I feel that among the IT majors, Infosys, which is consolidating closer to its record high, still shows strength. Though it's down nearly 1% today, so I feel it's a buying opportunity. So with stop at 1870, one can look for going long in Infosys with 2020, 2030 as a positional target. At the same time, one should maintain few shorts also because the market tone is negative. So we are seeing some bounce in REC, PFC today, but the trend has reversed post the consolidation range breakdown. So one can utilize this rebound to go short with stop loss at 525 and for the positional target of 460.
All right, REC and Infosys coming in. But thank you, Ajit. Thank you for taking out time, addressing the viewer queries and sharing your trading strategy. We hope that we connect with you soon as well.
Certainly. Thank you. Thank you so much, Ravisha.
Okay. Okay, let's just take quickly a check of the market, how it is holding up right now. Sensex and Nifty both trading in the green. Sensex up 0.1% above that 81,100 levels. Nifty also, it is flat in trade but mildly in the green above that 24,800 levels as well. The market breadth is fairly on the positive side. We're seeing number of advances outpacing the number of declines in the market breadth. Among sectors, Nifty Media Index, that is doing well. It is up about 1% each in today's trading session. However, Nifty Metal Pack, that is seeing a bit of a profit booking. It is down 2% in trade in today's trading session as well. Apart from that, Nifty 50 gainers, if we see M&M, Axis Bank, HUL, L&T, all of them doing well in the Nifty 50 list. Whereas the top losers include some of the metal names that has been dominating the list, which include the likes of Tata Steel, JSW Steel, Hindalco. Other than that, we have Tata Motors and Wipro also in the Nifty 50 losers list. But on that note, let's just quickly get on board with a fundamental analyst for the show, Raj Vyas of Teji Mandi. Raj, good morning. So good to have you on the show.
Hi, good morning. Thanks to having me on show.
Raj, we're seeing
Am I audible?
China come back trade. So how long do you think the story is going to last? Do you think it is a complete abandonment of India, just like how it happened with China when its property market had slumped?
So if you see overall, if we give the market structure, we had a good run in 2024 so far, and if you our view is clear that we are in a slight risk transition zone with markets likely to consolidate with a bearish bias. So it's not like that we are in a that the bull market is over. But given the fact that there is our market was richly valued compared to this China market. If you see on the valuation picture side, our market was trading somewhere around 20 to 25 times P, while China was trading around 7 times P, 7 to 8 times. So, given the fact that the recent the stimulus boost which the China has got, we see that the in terms of emerging market pack, the FI flows will be moving towards China for a near-term period. So basically, because of this reason, the China market looks good right now from the economy will get a boost because of the interest rate cuts and the stimulus measures that the country has got. And because of this reasons, we have seen some of the metal pegs also gaining the momentum. In fact, they were just at the breakout levels, and because of these reasons, the metal pack has also got a boost. And because that's it. Because if you see overall, this on in the near term period, we might see some bit of correction in our own market as well. But from I guess from a 1.5 month point of view. But overall, the long-term growth story remains intact in India. It's just a near-term perspective.
Okay, near-term perspective. Raj, you mentioned that the corrections have made India's valuations come down compared to China as well. But how much more corrections that will make India's valuations attractive for the FIs to make a comeback?
Yeah. So absolutely, because if we see when the markets are down, we basically talk about the volatility index, that is for India VIX, right? So if you see that is now at multi-year low levels, which is a positive part, right? Because it will not fall below this levels. But if we see on the contrary basis, then if the markets they are trading at the multi-year low levels, so from here on, we might see some pullback, or it may rise. So that gives you a picture that there is we might see some minor correction in the near term, but not much, because already the index is down 5% from the highs that we made on 26th or 27th of September. So these are the kind of 3 to 5% of correction is what we have seen in the many months, like every now and then. So 24,800 is something a strong support Nifty levels. If it breaks below that, then we might see some bit of more correction. Right now, there is some bit of stability. The markets are not falling much. We might see some bit of like minor corrections, but not a huge corrections. So that's the reason. And from the with the earnings season beginning, um, we don't see and like many a major correction. So that's the reason I talk, because from the 1 month perspective we might see a sideways consolidation, but from there on, then post the result season, then we might see a pickup in the markets as well.
All right. Pickup that can be expected from the earnings season as well. But Raj, Q1 earnings that was tepid, and yet markets discounted that and kept rallying. But now with geopolitical turmoil, FI exit, can the DI still discount a relatively subdued earnings season if it turns out to be so?
So over many months, DIIs have like have supported the markets. If you see, the FIIs were in a selling spree. It's just that past month or so, post the US cutting interest rate, and the FIIs have come back in picture. But because of again this China picture, we have seen FIIs selling relentlessly. But um, if you see, the Q1 results were soft because of two reasons. Because of the heat, and the other is the long elections that we were having, the general elections. So on a sequential basis, we might see a positive outcome in results, But on a year-on-year basis, if we compare the results, then we see the Q2 FY25 earnings to be a bit soft because the companies will be coming out with their results having a high base, right? So because of that reason, we might see soft earnings for Q2 as well. But on a sequential basis, we might see a positive momentum. And if you have seen from the quarterly updates as well, only a slight miss also has shown a negative correction in the stock prices. So even if the overall picture is good, but a slight negative bias is also bringing the stock prices down. So because of this reason, we might see Q2 earnings to be soft compared to YY basis, but on a sequential basis, we might see positive momentum because of the Q1 subdued Q1 earnings, as you mentioned.
Okay, since you mentioned that Q2 also, we are coming out with high Ps as well for the stocks, and Q2 earnings could also be subdued as well. But do you expect then the sell-off to extend from here on, given that the Q2 might not surprise the markets entirely as well?
So we might not see the kind of sell-off that we have witnessed in the past 4 5 days. The market may consolidate at the current levels, but it may not fall as much as we have seen in the last 4 5 trading sessions. Although if you see the stock prices have already corrected 30 40% from the highs that they have made. So the markets may consolidate, and it is a healthy sign because after a kind of a dream run that through the 2024. And this may also give a chance for the retail investors who has not got the entry point because the markets were rising and they were waiting for a bit of corrections. And this kind of corrections in the bull runs are healthy, and quality stocks are the ones to look on because these are the stocks that will bounce back from the current levels. So it's better to stick to quality pictures, having a growth oriented picture from near to medium term perspective. So markets may consolidate at the current levels, but they might not fall as we have seen, like the 4 5% more corrections that we have seen in the last 4 5 trading sections.
Okay, all right. 4-5% could not be possible. But any quantum that you're eyeing for, maybe 1 or 2% more extra, that the markets could see a bit of a downtick as well?
Yeah, so 1 2% is fine. Like
Yeah.
it's okay. Like already the because the markets are like right now they are moving based on the global picture. If there is some negative news coming in, then we are like our market is falling much compared to global peers, be it European markets, be it US markets. They are trading healthy. Like then we have to see that when the world was not performing, our market was the only market. And 2024, as I've mentioned, it has like our market has grown very much. So a bit of correction was on the cards, but this was something was not expected, 4 5% kind of a correction. But it's healthy because we might get chance to enter into quality stocks that are showing high earnings potential, which are having high growth, and they are also showing price momentum as well. So this is something an entry point because if you see, one should not time the market as well because if you see the past 30 35 years of history as well. So when you time the market and if it has went wrong, then your returns might come down from 30 times to 3 times, and if you miss the best 30 days of the market. So it's better to remain invested, and this is the point to invest in quality stocks having good growth potential. Their price momentum is also showing, and at this point of time, choose stocks which are not having, which are the beta is quite low compared to their sector peers. So this will give you a nice entry point and a good return as well as we move ahead.
Okay. Raj, let's talk about oil prices as well. Everyone was discounting the impact of rising Brent, but it is now up $10 per barrel from September end levels as well. So what does it mean for a heavily import reliant nation like India, as every $10 rise impacts India's fiscal health as well, and its balance of payments. So what do we expect on that front?
So as you mentioned, this is the rise in crude oil prices. It is because of two reasons, like the mid conflict that we were seeing, and the China stimulus measures that we have got. So because of these two reasons, the crude oil prices have risen. We don't see crude oil prices to further, like it's around. So it's the max that they can go is $90 or 95 per barrel, not more than that as we are expecting right now, because this is a short phenomenon, and once the and we don't see the Middle East tension to escalate further. It will slow down, and given the fact that and the we are not seeing not the recession kind of thing in the US as well. So the crude oil prices will gradually slow down as well, where it were trading around $70.
Okay, so some cool off that you expect for crude oil prices as well. But Raj,
Yeah.
just one final question before we let you go. Whenever there is a correction, sage investors, they always advise to hold before buying the dip. Do you also suggest investors to do the same at this point of time?
We suggest that's the reason I've mentioned, right? So look at the stocks which are having high earnings potential. They are showing the growth momentum is intact. Not highly. The beta is not high. Is not much high as compared to the peers, and so these are the three four. So look when buying the stocks, and we advise our investors as well to look at these three four parameters as well, because right now we are seeing stock prices are down. If you see yesterday itself, like more than 25 stocks of Nifty 50 were have corrected more than 5% since 26th or 27th of September, right? So this actually gives the earnings a good entry point from picture, and because the growth story of India is intact, it's just a near-term phenomenon of 1 month or 1.5 months till we have the earnings season. Once this is out, and once the US elections are done, we might see a slight recovery, and we might move ahead as well. And you don't know, we might see new highs as well on the index as well. This is the temporary phenomenon that we are seeing, but the growth story of India remains intact, and it's better to invest in quality stocks at current. If you have 100 rupees, maybe you can put 50, 60 rupees right now. If it falls further, then you can like invest more and do your investing as well.
Okay, all right. So that is the view coming in. India's growth story remains strong as well, and a little bit of a hold given we can see a little bit of a quantum of correction coming in as well. But thank you, Raj. Thank you for sharing your insights. It was
And
pleasure
also,
speaking to you
like
as well.
from the current
Yes.
junction, yeah,
Yeah.
if we can talk about the quality stocks, then we can see that with the kind of fall that we have seen in small and mid cap stocks. So in
Yeah.
the near term perspective, it's better to stay invested in large caps, because in which ways large caps has not performed well over the period compared to the broader markets. So from the near-term perspective, one can invest in large caps, and then in the small and mid caps, the companies which have remained stable and which are showing consistent earnings growth, and we can enter in those stocks as well.
Okay, all right. Large caps, that is the safe bet right now. But thank you, Raj. Thank you for sharing
Yes.
your insights. It was pleasure speaking to you, and I hope we connect soon as well.
Thanks.
Thank you. Let's just take a quick market check before we wrap up this edition of Opening Well as well. Sensex and Nifty, both of them, smartly, sustaining the gains as well. Sensex up about 200 points as well. Nifty up 63 points, 0.2% above that 24,850 levels. Majority of the shares are in the advances, outpacing the number of declines. What is Nifty Metal, however, that is seem to be doing not well, and that seems to be on the losing end of the markets as well. Nifty Auto, that is also seeing a bit of a profit taking. It is down about 0.1% in today's trading session. Bank Nifty, that is doing well, and that is the reason why we are seeing an uptick and recovery in the markets after 6 days of straight sell-off as well. Nifty FMCG, Nifty Pharma, all of these sectors doing well. Nifty Realty, however, is dipping in, flat in the red as well. India Wix, that still shows a sign of unease in the markets. It's up 0.6%, still floating above that 15 odd levels in today's trading session as well. Broader markets, that is seeing a rebound as well. Both of them, mid cap and small cap indices, they are up to 0.5% in today's trading session as well. Top gainers on the Nifty 50 list continue to be HUL, Bharat Electronics, Adani Ports, Axis Bank, Ultratech Cement, while on the top losers on the Nifty 50 continue to dominate the metal names, be it the likes of Tata Steel, JSW Steel, Hindalco. Titan from yesterday, that is also extending its sell-off. That is also down 1% each in today's trading session as well. But on that note, we have come to an end of this edition of the Opening Bell. But don't forget to tune in at 3:30 p.m. as we discuss how the session unfolded and which stocks moved the most. Until then, stay tuned to moneycontrol.com for all the news updates and market insights.